Hey harvesters, and welcome to the channel. My name is Matt. In today's video, I'm going to be going over the trades I executed for June 5th. I'm going to be talking about the covered calls, the cash secured puts, and everything in between when it comes to running options. Then we're going to take a step back. We're going to take a holistic view of the last 38 trading days and see how trading safe and easy options has progressed over that time period. And then lastly, we're going to go back to Robinhood. We're going to talk about some of the trades I plan on executing for tomorrow, June 6th. So stay tuned. For anyone that is a new viewer to the channel, this Robinhood account and this YouTube channel is dedicated for income generation. That's either daily, weekly, monthly, or yearly. I don't want to work for the next 30 years, wait till I'm 59 and a half years old before I can start using the money that I save and invested. I want to be able to use it now, either pay some bills, mortgage payment, truck payment, groceries, whatever. Or if I do this the right way over the next 3, 4, 5 years, I might be able to replace my W-2 income. So stay tuned to check out that journey. But for anyone that is a returning subscriber, usually what I like to do is I like to show my account value, and it's more so a sign of transparency that I'm actually running these trades, and you're either going to see my account grow over time or you're going to see my account diminish over time if I'm not doing the right things. But ideally, the goal is for it to increase. With that being said, the account is valued at $159,899.87. Let's head over to Robinhood and start talking about the individual trades I did for June 5th. All right, guys, for June 5th was a monster day. I made $439 of premium, which was probably the highest amount of premium I've made without capturing appreciation since I started running these options. So let's dive into what I actually did. The first thing when I did today when the market opened is I bought 100 shares of SPY, and I also bought 100 shares of QQQ. The 100 shares of SPY I bought at the 596.35. So theoretically, whenever I run my options, I want to choose a strike price higher than this number. Otherwise, I potentially risk realizing a loss. And then so what did I do? I ran a covered call and chose the 598 strike price. I made $107 of premium off of that quick little buy, the 100 shares of SPY, and then that covered call option. Ended the trading day, it expired worthless because the SPY closed at the 593.01. So that was a win on my book. The one thing I didn't like is I think I bought SPY a little bit too high. Just wanted to jump in, lock in some premium, but then the market kind of took a $4 dip. So my premium might suffer in the next couple of days, or the market's going to recover. We'll see how it plays out, but it is what it is. For QQQ, like I said, I bought 100 shares so I could run a covered call on the QQQ. And I bought those 100 shares at the 529.74, and I bagged $150 of premium running a covered call on QQQ. And QQQ premium is a little bit higher than SPY's. I might have to just maybe purely do QQQ. Either way, since I bought at the 529.74, when I'm choosing my strike price, I want to make sure that I'm choosing a price that is above my cost basis. So theoretically, I won't lose money. So I decided to choose something about $1.26 away from my buying costs, and then bagged $150 of premium. End of the trading day, expired worthless. So that was bingo, bango, no problem. Now let's talk about QQQ cash secured puts. But actually, before that, let me just head into what a covered call is for anyone that is a new viewer. So the way that a covered call works is you have to own 100 shares of an underlying. 100 shares is one options contract. And then once you have this 100 shares of a specific underlying or asset, then the options begin. So the way a covered call works, investors are going to pay you an upfront premium to lock in selling the shares that you own at a specific price. So because we'll use SPY's example, I chose the 598 strike price. I'm basically putting my shares of SPY for sale at this 598. And the investor basically is like, hey, the market goes up, I want to lock in buying those shares at 598. So then they're going to pay me an upfront premium to lock in that contract. So basically, we're making a deal. A contract is between the investor and the seller, and then that's how it works. Now, for a cash secured put, it's a little bit different. You don't actually own any shares. You're using collateral, and that collateral could either be margin or it can be cash. So the way this transaction works, an investor is going to pay you an upfront premium so that they can offload the shares that they own if the market heads in the opposite direction of going up. So the only thing that you need to bring in that transaction is collateral, but you need to bring enough collateral to buy 100 shares of an underlying. So for QQQ, when I ran this cash secured put, I chose a strike price of the 527. So I needed to bring about $52,700 of collateral so I can make this premium of $105. Let's talk about what I did. So for QQQ, I chose a strike price of this 527, made $105 for this from this contract, And at the end of the trading day, the QQQ was down to 524.70. So then I got assigned 100 shares of QQQ at the 527, but I made that $105 of premium. Second cash secured put I ran was also on the QQQ, and then I chose a 526 strike price. And when choosing that 526 strike price, I made $77 of premium. And then same thing with the one prior. Market closed at this 524.70. So I also got those shares of QQQ assigned. So because I got these two sets of QQQ assigned, I'm pretty much going to sell at the money until I get rid of these 200 shares of QQQ I just bought. Tomorrow, June 6th, I'm going to sell my QQQ, the ones I bought at the 527, at the 527 covered call, and then I'm going to do a covered call at the 526. And then for IWM and NVIDIA, those have been options that I've executed on June 3rd, and they're expiring this Friday. So nothing's really happening, that no extra money. I made that money up front back on June 3rd. So end of the trading day for June 5th, made $439. It was a pretty good harvest if you were to ask me. Head over to the overview screen and see how these last 38 trading days have gone. All right, guys, you know me. This is one of my favorite screens to go over, so let's dive into it. I started trading these covered calls and cash secured put option strategy April 11th. So it's been about 38 trading days since that time period. When the account started, it was at $86,312.66. And then currently now it is valued at $159,875.17. Just a little backstory. When I first started this, I had only $86,000 in the account. And then at about May 21st, I sold the primary residence I was living in and I had some spare cash. So I threw it in an account. So that's why there's a huge spike. All of a sudden, it wasn't because of a super cool quick trade. It was just I threw more money in the account. And so the number I use to calculate all of my percentages off of is this $146,312.66. It's just what I started plus 60,000, make the math nice and simple. But like I said, when we take the numbers into consideration, I'm up 9.23%. Before I did the $60,000 cash infusion into account, from that 86,000 to 97,000, I was up 12.79%. But then I threw that cash in there and it diluted my gains. And then now that I have a bigger number, I'm slowly starting to make more money as a result of it. But end of the day, it diluted it from the 12.79 and now it's at 9.27. But anyhoozle, after 38 trading days, I made $11,448.63 of premium or realized gain. So that is quite an impressive number if you were to ask me. Let's look at the trade win percentage. I'm winning 97.37% of my trades. I had 37 winning days and 1 losing day. The 1 losing day was it was based off of inexperience with rolling options and just finding a strategy that works for me. So I'm going to talk about that a little bit. This happened back on April 22nd. So I was only trading for about, 6 trading days before I made a major blunder. What I did is the cost basis. So I bought in at a higher price than what the market was trading at. And then I chose a strike price closer to where the market was trading at. But the problem is some random good news came out, market shot up, and then I had to roll my options. And then when I rolled my options, I was inexperienced in doing so. And therefore I didn't choose strike prices high enough, or I didn't choose strike prices or expiration days further away so I can make more premium. So ideally, I rolled my options and then the market kept going. And then eventually I realized that loss. So therefore, I know what I did wrong now. And there's a couple ways I'm resolving this problem. Don't ever choose a strike price below your cost basis. Or if I am going to roll my options, just choose an expiration day a few days later and make sure that the price you choose for that strike price with that new roll, make sure it's at your DCA or better. Otherwise, everything is golden so far. And since April 22nd, we do a quick little scroll, it is pure green. We haven't lost a trading day since then. See, it's all green numbers. But continuing forward, the average premium I make per day is about $301.28. If you look at the average weekly premium, I'm bagging in about $1,431.08. The average monthly premium is about $3,800. And in the yellow, I came up with some rough estimates. They may seem optimistic, but this is literally from the data that I have compiled over these last 38 trading days. Yes, the market has been up over that time period. So maybe if we cut, the premium to 20%, 30% less, that's still a lot of money. That'd still be about $50,000. So how I came up with this $74,416.10 is I took the weekly premium and multiplied it by 52 because there's 52 weeks in a year. And then we came up with this big number, and I hope we hit this number. And if you look at that $74,000 as a percentage, that's a 51% gain off of a $146,000 account. So that is quite fantastic if you ask me. Even if I can make something a third less of that, I still think that's a massive win. That'd still be about 30%. But when I first started this back April 11th, I came up with a very conservative, achievable goal of making $29,740 this first April all the way to the end of 2025. We bagged in $11,448 thus far, and we are getting closer and closer to meeting the 2025 goal. We only have $18,291 remaining. All right, now let's head over to the weekly data. Since this project started, we have completed 8 full weeks of trading, and through those 8 weeks of full trading weeks, we only had 1 red week, and that 1 red week was due to 1 bad trading day. But then since then, everything else has been green, and over the last 4 trading weeks, we've hit 4 digits. So we're in that $1,000 club for those 4 weeks in a row, and let's try to maintain that momentum until the end of 2025 and maybe forever. That'd be very nice. But we have 1 more trading day to go to make a little bit more money. If we can maybe squeeze out another $114 tomorrow on that Friday, I think that'd be a win, because $1,200 is a better number than just $1,000, right, guys? So we'll see how it plays out tomorrow. And for the monthly tracker, it's going to be very similar to what we're seeing for the weekly, because we haven't hit a full completed week of June yet. So it's going to be that $1,086. And for the yearly tracker, we've already mentioned this number. It's at $11,448.63. All right, guys, I'm loving these daily trades. Love seeing this money and this account grow. And hopefully yours is growing just as much as mine is. Okay, so let's head over to Robinhood, and then I'm going to talk about what I plan on doing for tomorrow. We're going to be talking about all the shares I own and the different contracts I'm going to run. Let's head over there and let's visualize it in person. Also, let me do one more call out, because I keep forgetting to talk about it every single time, but somebody has asked for it. For the month of May, the amount of margin costs I had to pay whenever my cash secured puts got assigned was $69.57. As you guys can see, I made $8,073. So that trade-off between making more premium and then the margin cost is so insignificant that I'm going to take that margin cost every single time. And especially I have a day job, and I wouldn't have a problem paying $69.57. So just another data point. Let's head over to Robinhood. For Robinhood, because I had 2 cash secured puts assigned on the QQQ, that means I have 200 additional shares. So currently right now, what I'm working with is 100 shares of SPY and then 300 shares of QQQ. I can run 1 covered call on SPY, 3 covered calls on QQQ. And let's take a look at my buying power real quick, because I want to point out one more thing. I still have about, $83,000 of contracts available. So I can theoretically run 1 more cash secured put tomorrow, but it kind of begs the question, how far do I want to go on margin? I really do not want to go too far. So I'm kind of get a feeler for what the market looks like. If it's shooting green, I'm going to be cool with running another cash secured put. And I might even throw another cash secured put in on NVIDIA that expires tomorrow. Just do a quick turn and burn play for NVIDIA, so I can maximize these event contract usage. However, if the market is trending red and the potential for cash secured put assignment is higher, I might just take a tactical pause, and I'll just take it easy, and then so I don't potentially get assigned another 100 shares of QQQ. So that's kind of what I'm thinking right now. We'll see what the market gives us tomorrow. I don't like to force things. I like to just take what the market is giving me. And that's how I've had most of my success. Every time I've tried to force money, like I did on April 22nd, I was trying to force more money, and then things started getting sloppy, and then you'll lose, $1,700 in a day. Cool. So let's head over to SPY first. Let's hit some covered calls. Alrighty. So trade SPY options. You guys know me, for all of my returning subscribers, don't do buy call. I don't like running poor man's covered calls. I don't like doing credit spreads. I don't like buying calls. because there's a lot more work you have to do to make sure whatever price you buying at and then the covered call you work is driving well. I think it's just simpler to just own the 100 shares and then just make sure you choose a price above your cost basis. Yes, the amount of money that you need to bring to the table might be a little bit less, but that's not the point here. I'm just trying to invest in a good funds and then make more money off of some of those funds. Let's see the buy call. 90-95% investors don't make money doing it, so I recommend don't do it either. And so let's do, to run a covered call, sell call. We are here for my trading strategy and philosophy. I like running options on ETFs that can produce a daily income or have 0 days to expiry. So that's QQQ, SPY, and then even the small cap like IWM, you could run it daily. But what I've learned just for IWM, I think a weekly premium is a little bit better because usually for the dailies, IWM premium is kind of small. But let's make sure we choose a 0 days to expire for SPY. Market is trading at this 594.97. And let's start talking about business here. So we're going to talk about what my situation is. Even though the market is trading at this 594.97, for me, because I bought these shares at this 596 range, I'm going to make sure so that I don't choose a strike price below my cost basis. I'm just going to round up to choose this 597. Let's see what the delta looks like for this 597. We have a 0.27, so that means there's a 27% chance of this contract executing successfully and getting assigned. So I like trading somewhere between a 0.2 to a 0.3, but I'm a little simpler than that, guys. I just do it off of dollar cost basis. So you see this 594, you go $3 or $5 above it, 1, 2, 3. That's usually a good bet. I might choose this 598 again. See what the delta looks like. Yeah. Let's see. This is the part where like it's up to you what you want to do. So this is a trade-off. So I can choose a strike price that's, a couple of dollars away from my buying cost at this 597. Premium is going to be $105. Or do I sacrifice, I don't know what the difference is, 78 to 105. What is that? 80, $27. If I sacrifice $27 of premium, if the market does go up to 598, I'll make $100 more. So it's trading upfront premium versus appreciation gain. I think for tomorrow, I might choose this 597 price, and we'll just go off of this. Like I mentioned earlier, to run a covered call, you need to own 100 shares of the underlying, 100 shares, one options contract. I own the 100 shares. I'm choosing this 597 strike price, and an investor is going to pay me $105 upfront premium to lock in selling my shares at the 597. Two scenarios that can happen because of this: expires worthless or you get assigned. So when it expires worthless, SPY is trading at this 594.90. It doesn't appreciate to this 597. You keep that upfront premium. You keep your shares. You rinse and repeat this strategy until you're financially independent and on a yacht. But the next thing that can happen is say that this SPY appreciates all the way up to 597 or higher. That means you are going to sell your shares at the specific price. And there's two different drawbacks for this. Let's say the market continued to shoot up. So basically, let's say it goes up to 607. So theoretically, if it shot up to 607, you lost the potential gain of that $1,000. However, nothing is guaranteed in life. So you didn't really miss out because at least you guaranteed premium and then you guaranteed some sort of appreciation. So, but then once it hits 607, it can go back down easily or it can keep going higher. It's the market. No one actually knows. It's just the best guess. And then if one tells you with conviction they know what's going to happen, well, they're lying. Cool. But let's talk about the other case scenario. Say that you finally, so say like for my circumstance, I bought the shares at this 596, but then the market doesn't actually appreciate, it depreciates. Say it goes down to 586. So it depreciated $1,000. And the only way you realize these gains or realize these losses is you have to sell at a loss. So the way you can avoid that is you choose strike prices around your dollar cost average area. If you start trying to choose strike prices where the market's at when it's lower, you're going to potentially risk getting your shares assigned at a loss. Or if you think they're going to get assigned at a loss, you can just roll your options contract. So that's kind of like something to look out for. So ideally for tomorrow, with my circumstance, I'm going to choose maybe this 597 or this 598. If the market's green, I'm probably going to choose this 598. If the market's kind of red, I'll probably choose this 597. So that's kind of my thought process right now. Now let's head over to QQQ. The same concept, guys. Go to trade QQQ option. Excuse me. Make sure you choose sell call, because that's how we run covered calls. And for QQQ, it's currently trading at this 526.10. I have bought the QQQ at the 526, 527, and I believe somewhere around the 529. So that's kind of where I'm going to put my options contracts. So the two cash secured put QQQ contracts I bought in at the 527. So I'm probably going to run one options contract on this 527 just to get rid of the margin as soon as possible. And same thing with this 526. I'm probably going to choose this 520. I'll probably choose two of this 527, because now I'll choose this 526. We'll lock it in. Okay. And then also, because I bought just 100 shares right off the bat today, somewhere between like the 529.31 or something, I'll probably choose a 530 strike price. Maybe I'll probably do the 531. Cool. So that's kind of how I'm picking my strategy for tomorrow. Those 200 shares of the QQQ that were assigned out after a cash secured put, trying to offload them immediately. But the shares I bought at the 529, I'm choosing like $1 or $2 away, so I can kind of capture a little bit more premium, capture a little bit more upside, so life would be good. And if everything stayed exactly the same when the market opens, I'm going to make $455 of premium. So that would be quite nice. And then let's talk about the potential cash secured put that's in my future. So to run a cash secured put, you do sell put. And let's look at some of these numbers. So market is trading at this 525.99. I don't have a cash secured put set, so I'll usually start looking $3 to $5 away. So let's look at this 521, see what this delta looks like. Wow, there's a 31% chance of this hitting. So I'd probably choose, if the premium is going to be this good at this 157, I'm going to choose this, no questions asked. And that's going to be a monster $600 day tomorrow. And that's not even talking about what we just looked at for SPY. But yeah, guys, let me talk about how a cash secured put works in this situation. So let's use this 521 strike price. Investor is going to pay you this upfront premium of $157 to you so that they can offload their shares if the market goes down from this 526 to this 521. The only thing that I need to bring as an investor is collateral to buy 100 shares of the underlying at this 521. So what does this mean for me? I need to bring $52,100 of collateral to run this cash secured put. So kind of like covered calls, there's two things that could go down. This option could expire worthless, or it can actually get assigned. When it expires worthless, you're going to make that upfront premium. The only thing you bring is your collateral. The market, the QQQ doesn't go to the strike price of 521. You basically get your collateral back. You get the upfront premium. You rinse and repeat this the next day. No problem. Other thing that happens, the investor pays you that upfront premium. And then the market goes down to 521, and then you get assigned, which means you are buying those 100 shares of QQQ from that investor. And then kind of like covered calls, you then run into those race conditions like, hey, did the market continue going down? If it continues going down, do I risk selling at a loss, choosing strike prices closer to at the money so I can make more premium? Or do I just stay safe and just wait for the market to recover, and I'll just sell at my dollar cost average mark? I'll make less premium, but I will not realize a loss, which is a potential strategy. Cool. So with that being said, guys, that wraps up the video. That's what I plan on doing for tomorrow. And man, if I can get $600 of premium tomorrow without any appreciation, that would be freaking amazing. Let me know what you guys think in the comment section. Matt out. I will see you in the next video. Stay harvesting.